Hello and welcome everyone to our webinar on how to tackle equity investing during the COVID crisis. I'm Alexei Zhurovsky, head of Unigestion's risk managed equity team, and I'm now joined by two of my colleagues, Alexandre Marquis, our head of client portfolio management.
Good afternoon.
And Gail Combe, our head of fundamental research.
Good afternoon.
So some housekeeping before we start. Alex, Gail, and myself will walk you through a short presentation during which you're very welcome to ask questions. Normally, you can post them in the text window on your screen, and we'll take some time at the end of the presentation to answer some of them. But if we don't get to your question today, we will follow up afterwards. And if you have any additional questions following the webinar, please reach out to your sales contact and we'll be sure to get back to you. With this being said, I suggest we start now by looking at where equity markets are today versus the end of last year. Yes. Because of course, even if 2019 feels like really old news and a lot has changed, some style characteristics within equities have remained surprisingly similar, which makes the current bear market really special, at least so far. As you can see on the left side of the page, at the end of 2019, equities had the best year since 2009. And pictured by our internal nowcaster level, macroeconomic activity was, if not flamboyant, but still healthy, with quite logically elevated valuation multiples. In this slide, you can see the Bloomberg best price to earnings multiple, which is the highest reading we have since mid-2000s. And in terms of style, as it is often the case in bullish markets, we have growth significantly outperforming value and high volatility stocks outperforming low volatility companies. So far, nothing special for 2019. But if we look at the right-hand side of the chart, we have the same indicators today. And equity returns are, of course, very depressed. And the macro figures, as pictured once again by the nowcaster indicator we use, has the worst reading I have personally seen, which is at -2 standard deviations. And given all this, it's so surprising that there is very little rotation actually in terms of equity style. Because if you look at the circle on this page, growth is still outperforming value and high volatility stocks are still outperforming low volatility stocks, which is very surprising and a good illustration how strange and unusual the current crisis is. Which is, I think, is a good segue to the table of contents for our presentation. What we wanted to address is three questions. First of all, what makes the current crisis so unique, at least so far? What has worked and what didn't work in the risk management equity strategies which are run by our team? And finally, what could we expect going forward in the second half of the year? Or in other words, what market trends could, in our view, persist, and what could mean revert in the coming months and quarters. But before we get to this forward-looking part of the presentation, it may be important to look back on what exactly happened in Q1. Starting from one immediate observation, which is the speed of the correction as it happened in February. We see on this page the COVID crisis in red, picturing the performance of the MSCI World Index since February 19. And this chart is overlaid with other bear markets, such as 1987, the technology bubble burst, and of course, the great financial crisis. And as you can observe, the COVID sell-off happened astonishingly fast. And if history is a guidance, this initial drop could be just the beginning of a downside-oriented range trading market with rallies, drops, and a generally elevated level of volatility. Usually, such big drops are symptomatic of a state of confusion, and we see it very well with our risk indicators in February this year. On this page, you can see different risk indicators which we use. So you have our traditional macro-based nowcaster in red, which pictures the general macroeconomical variables to describe the level of activity in the general economy. But you also have the blue curve, which is a big data news flow sentiment indicator on the stock market. And this blue line has none of the usual slow-moving macro indicators, and it shows very well because it drops much faster than the red line does. You can see that from mid-February, it goes down. And as my colleague Gail will discuss in a moment, these news flow signals are very useful to, as a catalyst for our fundamental team to review potentially affected stocks in our portfolio in case of change or in case of crisis breaking in. Going back to the market reaction, given the elusive and hard to understand nature of the virus, investors first focused on what they could understand, which is the immediate impact of quarantine and people staying at home, which is why very early in the crisis, you had very little differentiation by style. And one example here is low volatility. As you can see in this chart, you have the market being broken down between high volatility stocks in green. There you have different quintiles with Q5 being the riskiest stocks in terms of backward-looking volatility. And as you can see, these high volatile stocks underperformed significantly in other bear markets, such as the dot-com bubble, the great financial crisis. But big surprise, during COVID-19, you see all the lines sticking together, which signals very high correlation and very low dispersion in the market, at least based on volatility. And then another surprise, you see that the green curve, which is the highest volatility stocks, actually are doing pretty well. As you see them outperforming in many geographies, especially the US market, the rest of the stocks, which is quite unusual versus some of the other bear markets we have seen in history. And this is, of course, very bad if you would have just the low historical volatility as your only instrument for capital protection. As you may know, in our investment process, while volatility is one factor which we use, we also rely on many other risk dimensions, which are the fundamental soundness of companies, of course, macroeconomical and news flow indicators, valuation, ESG, etc. So at this point, I wanted to leave my colleague Alex to describe what has worked well and what has worked less well since the beginning of the year in the current crisis environment.
Indeed, like when you look at that chart, you see that we use both statistical metrics of risk, fundamental metrics of risk, and we also try to encompass other metrics by trying to add some forward-looking analysis of what's going on in the market and at the company level. If we move to the next slide, we see that some statistical measures of risk didn't protect as much as we could have expected. You see the blue line here represents the average pairwise correlation within our investment universe. Here is the MSCI All Countries World. And you see how this pairwise correlation has spiked in March 2020. This implies that basically some traditional defensive sectors recorrelated with the drop of the market and failed to provide protection. We can think of utilities which failed to provide during the early days of the crisis. And at the same time, you had some, I would say, unatypical defensive sectors, or not really defensive sectors, that did provide some protection. And we can think, obviously, of the software industry, which proved very resilient from the stay-at-home theme that we've seen playing in the market. If we look at other style factors on the next page, I think what's pretty striking is the lack of defensiveness of the valuation factor. The value factor had an horrendous quarter, one of the worst over the past 2 decades. In that very particular market, both legs of the value factor did have an extreme behavior. On the cheap side of the value factor, the oil crash, following the failed negotiations of the OPEC, crippled the energy sector as well as the banking sector, and those two sectors had already pretty depressed valuations. On the other side, you had highly expensive stocks, in particular in the tech industry, which resisted impressively well in the market downturn. And those stocks, they had pretty high growth expectations and consequently very stretched valuations, which explains this minus 18% in 2020. You see that basically the worst period for the value factor was during the downturn between February 19th and March 23rd. It also happened slightly before when the market was still positive in basically the wave of optimism that followed the US-China trade deal. And we saw a bit of reversion after March 23rd, but it wasn't sufficient, obviously, to recover. What's pretty striking as well is the astonishing behavior of the momentum factor, which, as you can see, is the strongest factor year to date and managed to deliver positive returns in the three sub-periods we highlighted. And this is pretty atypical given that the momentum factor is usually very prone to mean reversion when market stress is existing, and obviously the COVID-19 crisis has been, I say, a very strong example of market stress. Now looking at other factors, you see that quality managed to protect a bit during the downturn, probably not as much as we would have seen in the past. Just comparing it to the behavior of the momentum factor gives you the lack of protection of quality. And beyond the quality factor, we can distinguish between profitability and safety metrics. And here we see that the best metrics for protection were the traditional safety metrics, id-est, leverage, or ability to repay the debt, as investors were seeking to find companies with pretty robust financial situation. Finally, what we can expect as well from the size factor, you see that size didn't protect it as well. There was some, we will see later with the FANGs, some outperformance of the big names, and this is a behavior that we shouldn't expect in the future recession that we will navigate. So that was more for the style factor, quantitative metrics of risk that we monitor for our portfolios. And now I will let Gael comment on the more discretionary review of companies and how we reacted to those events that happened in the market in 2020.
Our 360-degree approach bundles fundamental analysis with our quantitative and systematic process. And we've been doing so for many years, as you can see on the right-hand side. So the dark blue line represents the absolute performance of positive ratings, and the light blue, the negative ratings. Obviously, the value is in the spread between the two lines. In the particular situation of this crisis, our fundamental analysis capability allowed us to quickly review sectors and stocks that are experiencing drastic changes, ranging from the transport industry to the real estate sector. On page 14, you can see some examples of stocks we sold on the basis of our fundamental review, and we mostly took action before the model could integrate market changes. So in reviewing our holdings, we essentially ask ourselves two key questions. First, what is the visibility in terms of demand? And it is pretty clear that tourism, the transport industry, or some real estate exposure are deeply impacted today. Second, what is the financing or refinancing risk if the low level of demand remains for an extended period? And here I can mention companies like Compass, Carnival, or Krung Thai Bank in Thailand that face such risk. On the right-hand side, you can see the relative performance of these decisions so far. And most of the stock we sold underperformed since then. Moving on to page 15, I would like to focus on the case of Lufthansa, as it illustrates well what we aim at with our fundamental analysis. The objective is not to select stocks out of the blue, but to review stocks selected by our quantitative process and identify risks that are mispriced. On these charts, you have Lufthansa share price in blue, its volatility in orange, and when we sold the stock in dash red. As you can see, for some time the stock was moderately volatile, but as the outbreak started, we saw that risks were mispriced, and we sold the position end of January. Thereafter, we can observe the stock price went down significantly and volatility spiked. Now let's Alexei talk about our dynamic risk model.
Yes, Lufthansa is a very good example to do that because it's one stock which saw its statistical risk properties change completely from one day to the other. And in the current environment, historical volatility is often a poor guidance for current and future risk, as your historical time window would simply average out the new and the more recent past without too much distinction. Which is why, since a couple of years now, we've been relying on what we call a dynamic risk model instead of a static approach, which is mostly used in the commercial models you see. And by dynamic, we mean automatic adjustment of the historical look-back period to shorten the effective risk estimation window in periods when volatility is high. And in order to have the immediate reading of volatility, we utilize the VIX index, which is quite reactive, as you know. And this does produce a much more accurate risk estimation during regime changes when the estimation window effectively shortens, giving you the best current forecast. And when VIX level is low, then it's basically making the forecast more stable by expanding the look-back period. And as a consequence of that, when you don't need a more accurate risk estimation when markets are calm, then you have less turnover and less transaction cost. So as you see on the page comparing these two models, so there you have a static approach, which is the dark blue bar, and you have an example here which estimates beta on several sectors. So you see, for example, technology is a stark example. When the dark blue bar and the light blue bar are different, you can see that a static 3-year estimation does produce a very high reading for the technology beta, which is above 1.2. But if you utilize a dynamic approach, then you have a much more current estimate of what the current beta of technology stocks is. And of course, as you can see, as the technology sector in general performed quite well during Q1, there you have a much more current and much more realistic, I would say, expectation of the current state of market risk embedded in technology stocks. And this, I believe, is a big enigma in some way, because some people would say that technology is becoming the new defensive, which is, looking forward, one of the questions which we wanted to address in the forward-looking section of this presentation. So we wanted to give our take on whether technology is the new defensive, and more importantly, are all technology stocks equally defensive? Then second question is the value momentum spread. So since the beginning of the year, we've seen that the value investment style hasn't worked and had one of the worst periods versus momentum, which worked exceptionally well. We wanted to address this question from the risk perspective and also expand on how our portfolio is positioned on this value versus momentum style. And last but not least, we wanted to discuss other investment styles and other factors and explain you how our portfolio is positioned for the second half of the year, especially if we take into account a likely recession scenario going forward. But let's start with technology. And in the top left corner on this page, you would find maybe the most famous technology stocks, the so-called FANGs, the Facebook, Amazon, Apple, Microsoft, and Google. And you have their performance this year on the top left corner once again. So amazing fact, all of the FANGs are actually positive since the beginning of the year, while market indices are in double-digit negative territory. And as you can see, this has not been the case in some of the other historical bear markets, including some of the recent periods, such as Q4 2018, where you see on the top right corner, the FANGs underperforming quite significantly the market on the downside. Same underperformance in general happened during the Eurozone crisis in 2010. And of course, during the great financial crisis, the FANGs underperformed as well. So the big question is, how repeatable is the first quarter of 2020, and how much protection could you expect from the FANGs going forward? So in order to answer this, I think that it's useful to understand the shape of the market, and especially the relative size technology and top technology names have in the MSCI World Index. So on this page, you can see the biggest constituents of the index. And as you can see on the top of the page, in 2001, for example, the top holding of the MSCI World Index was General Electric, followed by Microsoft, Exxon, Citi, and Walmart. So the top 5 holdings of the index at that time represented less than 5% of the index. And as you can see, we had decent sector diversification in terms of the top holdings because they were all in rather different and uncorrelated sectors. Now in 2019, as you can see on the bottom side of the page, the picture is very different. The FANGs are the top 5 stocks of the index themselves. And as you can see, there is very little sector diversification. If we take into account that technology and internet communication are extremely similar in behavior and share a high correlation. What you can also see by the relative size of the bubbles is that the index is vastly more concentrated today, with the top 5 stocks being almost double in size combined and approaching 10% of MSCI World. So I think that it's a nice way to sum up the pros and cons in holding these big technology stocks. And on the pro side is their competitive advantage, especially during quarantine situation, which materialized in excellent performance in Q1 and beyond Q1. These companies also tend to have strong balance sheets with quite a bit of cash, and from a fundamental quality perspective, they're ticking quite a few boxes, but they're quite big in the index. And nowadays, as with the ETF market being extremely active, these stocks tend to be traded as basket, which makes them very sensitive to outflows from the index, especially from passive instruments being indexed on MSCI World and S&P. And this is, of course, a problem if the bear market is continuing and if we continue to see outflows from equities. As we have seen on the previous page in terms of performance in some of the other bear markets, these big technology names are still quite sensitive to consumer demand and the economical cycle, hence their underperformance end of 2018, for example. And their competitive advantage may be fading away as they just become too big, and potentially consistent innovation is much harder to achieve. So we really believe that it's a more nuanced picture, but maybe the biggest risk is that these stocks may be on the wrong side of the so-called value momentum spread. And let me show you what I'm talking about, because on this page, you have the historical return of growth and momentum styles versus value. And as you can see, the spread between these styles is reaching historically unprecedented levels, in some way even beating the euphorical performance of technology and cyclicals in the dot-com bubble in the late 90s. And this, of course, as we hit these levels, we may conclude that some part of the good news and some part of competitive advantage these stocks have is already priced in, And at some point, we could be at the mercy of mean reversion of these curves back to normal. So, and of course, if we take into account this risk, we need to realize that in a typical momentum basket, which you can see on page 22, the FANGs represent the biggest weight because they're so heavily weighted in all capitalization weighted indices. So as you can see, we have another weight column on this page, which is our current portfolio weight. And now going to our portfolio, as you can see, in terms of our momentum exposure, we don't like to hold these large cap names, and we much prefer implementing momentum with a different set of names, where we can achieve more sector diversification, because as you can see, we can have some less cyclical exposure even in momentum stocks with companies such as Nestle and Procter & Gamble. And we can have a different kind of technology exposure through companies such as TSMC, here towards the middle of the page, or AT&T. And this is, of course, different exposure in terms of momentum. And in our view, it enables us to have a more risk-proof allocation to this momentum style. So kind of, I think that as you probably can see in this chart, one of the risks which we try to tackle with our momentum exposure is to make sure that we're not overly sensitive to the cyclical earnings risk associated with the FANGs. And speaking about earnings, I wanted to let Alex once again discuss some of the potential earnings surprises which we could have from the current levels. Oops. My colleague Alex might be on mute.
My bad. I was actually saying that the big caveat to invest in growth stocks currently is obviously you get a very strong exposure to the coming recession that is likely to happen in 2020 and possibly to extend in 2021. If you look at the right chart here, you have some economic forecasts for several developed economies, and you see that for now we range between -5% and -8% going forward. Obviously, those companies, they have some operational leverage, and when things go bad for the economy, it's likely that we will see strong impacts on the consumption, on the capital expenditures, and in particular in the tech sector, which nowadays is a big share of the capital expenditures of companies. And at the same time, we have a market that rebounded very sharply in April, while obviously the earnings situation continued to deteriorate. And if you look currently at where the performance of the market stands, we are basically back where we were in 2019 in October, at a time where obviously the concerns on global growth were much less important. We are discussing the impact of Brexit or the potential failure of the US-China deal, which didn't happen eventually. And obviously the current sanitary crisis that we face is much bigger in terms of impact on the global economy. And the translation effect that we will see on earnings is likely to extend for the end of the year. You see now we have about 25% earnings compression, and we are not very optimistic on the trend of those earnings going forward. So now the question is, what is the right positioning to navigate a recessionary environment in the next quarters? And on the next slide, we see that history teaches us that some factors perform much better than others when the world is living painful times for the economy. So here we have analyzed the last 20 years through the lens of our nowcasted indicators, and we have calculated the annualized average factor returns depending on how high the recession risk is for the global economy, from very low risk in dark blue to very high risk in green. And I think results are pretty striking visually. Momentum appears to be the worst performing factor in such adverse environments, which is intuitive. And I would say the other intuition is that the best environment for low volatility stocks is high risk of recession. We also see that value benefits from a recessionary scenario. as companies which valuation reflects high growth expectations tend to disappoint more frequently as global consumption and investment are impacted. Finally, quality is also paying off as companies with more robust financial situations and less shiny but more stable earnings tend to suffer less when global growth is a concern. And I will conclude with mega caps that tend to underperform. You can see with the size factor where mid and small caps tend to outperform the mega caps. And it's mainly because those mega caps, they concentrate the high hopes that usually precedes recession and that push their weight up in the benchmark. So now I will let Alexei introduce you to the core holdings of our global equity strategy and how we are positioned from both a style perspective and the fundamental perspective, which is our best proxy to estimate the future risk for the stocks going forward.
Yes, so on this page, you can see how we gain exposure to the styles Alex mentioned through specific names and stock picking. Once again, you can easily spot the factor exposures which we like for the medium term. First of all, high fundamental quality with a superior balance sheet, more stable earnings, less reliance on accruals and other aggressive accounting practices. We believe that it's very important to control ESG exposure, also because, well, we have more external risks as we go through this crisis. For instance, governance, for example, we know that the probability of accounting fraud is more frequent during the time of turmoil because the companies have compressed earnings and they want to be a bit more creative in terms of how they may stretch the boundaries of accounting. As you can see from the valuation column on this table, we may accept to pay a price which is higher than usually for some of these names such as Nestle, but it doesn't mean that we are ready to buy momentum stocks irrespective of their valuation indicators. Although one needs to take special care in measuring valuation during the current crisis, because as you might expect, looking at the earnings estimates and the market volatility in terms of price, we need to make sure that the valuation indicators which we observe are sound in the current environment and mean something, which means more fundamental work. And there we believe that we have a clear advantage versus some of the other quant-only approaches because we can go into more detail of the sustainability of the business model and the impact of COVID in terms of change to the company business and to valuation metrics. As Gael, I believe, has shown on some of the more recent work he has done and with his team in terms of assessing the true fundamental stability of stocks. So we believe that the combination of unemotional quant indicators which we use and fundamental judgment is providing a good mix in terms of how to implement the excellent quality, decent growth, and reasonable price policies which we have for the portfolio. And from a stock picking point of view, we believe that the health dimension of the current crisis will persist with likely more government budget allocated to health and people caring more about their well-being. Hence, you can see that two of the top holdings we have are in the pharma and health sector, which we believe is an important exposure to have in the coming quarters. To conclude, our central scenario for the coming months means recession and weaker than usual demand and some earnings compression. So we can summarize our positioning in the last two columns. We want to have in the portfolio companies which have low sensitivity to demand shocks, and this is paramount in our view in order to ensure good downside protection. And we also want to have companies with better balance sheet and less need for refinancing, because we believe that chances are the balance sheet strength and the fundamental quality would be very key going forward. So at this point, I wanted to conclude with the three questions which we discussed in this forward-looking section of the presentation. So is tech the new defensive? Well, it has been in Q1 and in April and May, but we see quite a few clouds on the horizon for the future. As you have seen, we like to invest in tech with different names than the FANGs, and we believe that there's considerable market risk in terms of mean reversion, potentially liquidity if we have outflows from the equity market on the big names in tech. And of course, we believe that quite a lot of the good news and quite a lot of the competitive advantages may be priced in. And this is a logical transition to the second question. Is value dead? Well, this may be a philosophical debate, but we don't believe that we should stop looking at valuation. Even if we recognize that it's much more difficult to know what a reasonable price means in the current changing environment. So in our portfolio, we don't hunt for deep value, recognizing the inherent risks, but we also exclude some of the exuberantly expensive names, many of which are large caps in the index, which have already performed very well since the beginning of the year. And what styles do we like to make our portfolio well equipped for potential future risks? Well, first of all, I'm repeating myself, but we believe that fundamental quality is paramount. We believe that positive ESG tilt is much more than the feel-good dimension of ESG, because we see ESG risk materializing more in times of crisis, and we believe that the ESG controls should be strong. We like avoiding valuation extremes on both ends of the spectrum, and we don't want to position ourselves on the bad side of this value momentum spread, because we believe that there is a potential risk of mean reversion. And at the same time, we don't want to take a philosophical stance on value, because we believe that in terms of the deep value exposure, there are clear risks which we don't want to play in the portfolio. And last but not least, diversification. I'm not very popular here because you know that diversification hasn't worked in the last 5 years. It was a clear challenge to have a diversified portfolio in Q1 because large caps continued to perform extremely well. But we believe that if we go to this range trading environment with rebound and market drops, diversification is what you should have. Because when the risks are uncertain, then a diversified portfolio usually is behaving much better. So that, I think, is my conclusion for this webinar. I don't know if we have questions at this point. Let me see. Yes, I think we have one question on the so-called smart beta and low volatility indices. So people ask, given one of the first pages which we show in the presentation here, let me go back to the this market differentiation by volatility, which is this slide. Some people ask, why would a low volatility index still outperform, given that the simplistic low volatility factor hasn't worked year to date? And I think that the answer here is related to the value momentum exposure in some way, because some of these low volatility indices have big relative constraints. As a consequence of that, they will be sometimes over allocated to momentum, because momentum has worked extremely well, and it's tempting to include more momentum in your volatility basket. But at the same time, in our view, this is playing an unintended bet inside a low volatility exposure, because from a pure low volatility perspective, well, you shouldn't perform as well as some of the smart beta indices have performed. And this is, in our view, largely due to this momentum exposure, which is not controlled. So I'm receiving the message that we sadly don't have more time to address questions, but I would like to thank Alexandre and Gail for helping me for this webinar. Obviously, I would like to thank the audience. I'm being told that there is a survey at the end of this webinar, which doesn't take more than 1 minute. So big thanks in advance if you could fill this up. And otherwise, I hope to see you again in the next equity webinar, which we will run, I imagine, the next few weeks. Thank you so much at this stage.
Thank you for attending.